Hello and welcome to another episode of the Accredited Investors Only podcast presented by Accredited Life. I am your host, Peter Neal. Thank you so much for joining me today for another great episode that we have lined up with an awesome interview in store. But before we get there, I always like to ask and talk a little bit about, are you living your accredited life? So it's the beginning of the year still. We're just coming up on the end of January, and I talked about it in the last episode. I don't know if you're the kind of person that does a lot of resolutions and things like that, and you have a bunch of goals set, or if you're the kind of person that's kind of always living that way and always chasing after your goals and things like that. But I think we could probably all agree there's certain aspects of our life, whether it be in the bucket of self and our relationship to ourself, with others, to God, to the world, all that kind of stuff. And there's obviously our health and, internally, externally, mental, physical, all that stuff. And then your wealth, how you feel from a financial standpoint, how your bank account looks, how your portfolio looks, all that kind of stuff. So within those three buckets, if you know me, I'm probably maybe just realizing this. I like to compartmentalize things. So I always look at real estate as acquisitions, execution, and capital. So usually I say capital, acquisitions, and execution, and life itself, health and wealth. And then within those categories, we can kind of fill out all the different aspects and all the different tentacles of our life and things that we do. So within the self, health, and wealth, there's always things that we can do in our personal life and in our professional life, and in our social life that we can probably improve on in some way, shape, or form. And I think now, in the beginning of a new year, is a great time to be examining what's working for you, what's not working for you, and kind of zoom out, at the end, into the end. Put yourself in December of 2025, in January of 2026, and say to yourself, what is it that I have wanted to accomplish? What have I accomplished? Look at it from a standpoint as if you have done those things, and then work yourself backwards, and it doesn't have to be, you don't have to know all the steps to how you're going to get there, because sometimes God and life has a way of leading us down paths that maybe we never expected, or getting us to something that we wanted in a different way than we ever expected. So I always think it's important to leave room for surprises and things like that. And, but obviously you want to have some idea of where you're heading in some way, shape, or form. So hopefully, as we're getting to the end of January here, you've been reflecting on what in 2024 worked for you, what in life in general has worked for you, and you're thinking about how you want this year, where you want this year to be, and ideally you've started working towards that already. So today on the podcast, we have a great interview lined up. This is someone who I think is really doing an amazing job at living their accredited life, and somebody that's built a really great foundation, has a really great vision for their business, and not only for their business, but for their personal life. They're somebody who cares a lot about Christian ministries and living a Christian lifestyle. So I want to welcome to the show Zane Schartz. He is the president of Freedom Commercial Real Estate, and the visionary behind Freedom Commercial Real Estate. He has over 8 years of expertise in the private equity real estate investing space, managing over a portfolio of 6 commercial real estate funds with over 70 assets, totaling more than $700 million in assets under management. Absolutely love what Zane is doing and the strategy he's deploying with triple net properties, with retail, triple net properties, and on the commercial side of multifamily, commercial side of residential and all. So really excited to bring Zane onto the show. Let's get right into that interview.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Zane, welcome to the show. How you feeling today?
I'm good. Ready to roll.
Ready to rock and roll. So introduce yourself in your own words, Zane.
Yep. So my name's Zane Schartz. I'm the president of Freedom Commercial Real Estate. Freedom Commercial Real Estate is a private equity real estate investing firm where we buy commercial assets that are stabilized and cash flowing from day one. The name Freedom Commercial Real Estate comes from two things. We want to help investors on their journey towards financial freedom, and we think that comes through cash flow and stabilized cash flowing assets. And then the second meaning behind it is freedom in Christ. I'm a Christian, and that's the most important thing about me. And I want to treat people with the morals and ethics that come with being a Christian, and I want to run my business that way too. So right now, for example, two of our current offerings that we're doing is one of them's a fund of triple net assets. Think Starbucks, Dollar General, AutoZone, all investment grade tenants paying our rent. And we're going to build that fund to have about 15 to 20 different assets in it. And that does monthly cash flow distribution. So cash flow, cash flow, cash flow. And then we'll roll that up and sell it to a private equity group. So that's that one. And then we have an A-class stabilized, 97% occupied, 2022 build, all townhome style apartment complex that we're raising for, again, stabilized, cash flowing. So we're big on cash flow. We want our investments to be where investors can come and just know that they're going to get stable, consistent, steady cash flow. That's all we're about, with the benefits of appreciation from real estate and the tax benefits of depreciation. So everything we do is making money from day one, and that's what I wanted to build, and we're building it.
Wow, that's awesome. Well, there's so many things to break down there, and I don't know where to get started. Actually, let's get started there. How did you get started, Zane?
So I knew my whole life that I wanted to be in real estate in some capacity. So I did internships in college at a few different firms. One of them was a development firm. The other was a private equity group, and another was just a brokerage firm. So kind of learned a little bit about real estate and what I liked and what I didn't like and what I wanted to do. So I started working at a private equity group where I was there for 6 years, and we grew from $150 million of assets under management to $700 million at the time I left in about 5 or 6 years. Had a lot of success there. It was fun. I was chief investment officer there, grew a lot of the funds and built the funds there and learned a lot. And then summer of 2023, I wanted to start my own thing, and here we are a year and a half later, and we've got 50 or so assets under management, so we're in a good spot.
Wow, that's amazing. What would you remember, like, what your first introduction to real estate was? Because this is something I talk about all the time. My father was a property manager, so that was like growing up. I was like, I don't know if I want to do that. You know what I mean? So I was introduced early on, but it wasn't until I was out of college that I got bit by the real estate bug. And so all my internships were in like media and TV, radio, that kind of thing. So when I hear somebody like you who took internships in real estate and knew that from an early age, I just think, oh, that's awesome. If I could go back in time, that's what I would do. So what was that first introduction for you like?
So I'd say, like, growing up, my parents had some single family rentals. They probably had like 5 or 6. I knew that wasn't what I wanted to do, but they always encouraged me and my siblings to own our own business and be our own boss pretty much. So in college, I did like comprehensive analysis kind of like, what do all the richest people in the world do? So I went to the Forbes top 100 billionaires, and I said, what are all these guys doing? How do they make their money? And it was either they were doing tech, they either inherited it, they had some type of product or service, or real estate was a big one. I was like, well, I can't do any of these first 3. So real estate is one that I also was interested in, and I just know all the wealthy people own real estate. So I was like, okay, what is my barrier of entry and how do I get into that? So private equity was kind of what I landed on through those internships of what I liked and kind of what I wanted to do. So a little bit of my parents doing what they did, and then a little bit of just my own research leading to where I'm at.
That's amazing. So what would you say, like, your experience was working at different, you said private equity, work with developers, brokerages, like what was the experience that you had there? And then how much of that experience have you taken with you into Freedom now?
Yeah. So, I mean, I'd say a lot of the internship I had at the development firms was a lot of just sitting in on meetings and being like, is this something that I could see myself doing for life? It was less hands-on and more just shadowing and kind of pencil pushing, basically. And I was like, I don't think this is what I want to do. The private equity side was more interesting because there's a lot of people that trust you, and like you have to build trust and earn their trust through years of success and years of communication and years of just doing things the right way. Trust is gained in drops and lost in buckets. That's a very good quote that I think is very good for this. So the private equity side, I like that there's a lot of different pieces when you're looking at a deal. You can say, hey, I want to put good debt on this. Hey, I want to find the best property. Hey, I want to find the best investors. Like there's just a lot of different pieces that you can say, like, what can I do to fine tune this investment for investors to have the highest returns? And you can all of them, you can just do it a million different ways, which I really like. So I was an athlete my whole life. I played pro hockey, and kind of, you work backwards when you're playing sports of like, hey, I want to win the championship. So what do I do to get me to the championship game to win? So here I'm like, hey, I want to build the best investment opportunity, and how can I reverse engineer that to get to my investors in the end? So, yeah.
That's amazing. Now, the private equity firm, what was their focus, would you say? Was there any asset class particular, or were they diversified, or what?
Yeah. So they had 3 branches. One of them was development, and they did a lot of office space conversion to multifamily. And then they had existing multifamily value add, so C class to B class, or some D class to C class value add, put $10,000 into each unit and sell it for more. And then they had the third branch, which was the triple net assets, Dollar Generals, CVS, Walgreens, Verizon, Starbucks, etc. I ran the triple net stuff entirely when I was there. I did the acquisitions and underwritings for the existing multifamily, and then I didn't do anything for the development or conversions. That was outside of my wheelhouse, and it was just something I didn't know a lot about. So I stuck with what I knew, which was multifamily and triple net stuff, and that's what we're doing now at Freedom.
Gotcha. Well, yeah, that was going to be my next question, was like kind of what led to the triple net side, because I think I've always been fascinated by that part of the business. And before we started the podcast, I was telling you I did a commercial, what I like to call like an apprenticeship, a few years ago with a commercial investor, developer, broker, and he loved triple net, and around here in the Philadelphia area, Wawa is a big one, Chick-fil-A. But you name it, Dollar General, Taco Bell. So what is it about that asset class that you like? And then there's so many questions I have about it, because you got into it at a time where I'm sure the interest rates were probably compressing cap rates massively, right? You know what I mean? So how have you navigated it over the last few years? How has it changed? Like, so it sounds like you've been in that space for a while. How have you seen that evolution over the last few years, especially because interest rates are going to have a big effect on that, more so probably than like almost any other, asset class in the real estate space?
Yeah. Well, let me first talk about why I like it, and then I'll talk about how it's changed. But if I forget about that second question, remind me. So the thing I like about it is we create a fund that can be very diversified in terms of tenant type, geographic location, lease terms. But everything we buy is an investment grade tenant, meaning that the companies backing our leases and paying our rents are multi-billion-dollar corporations. We don't buy anything that is a franchise, mom and pops, or everything we buy we are 100% investment grade. And we like that because even if, let's say, we have a Starbucks and it has 10 years left on the lease, we're guaranteed rent for if it has 10 years left on the lease, we're guaranteed rent for 10 years. Even if Starbucks tomorrow says, hey, we don't like this location, we're shutting it down, they still have to pay us. They're obligated to pay us. So if that's a mom and pop nail salon and, they're not doing well and they go bankrupt, that's a vacancy that you have to fill. So we like the fact that it's very stable, very consistent. We know what we're getting. We put good debt on it, fixed rate debt. So we know what we're having. We're basically buying a bond that's backed by a multi-billion-dollar corporation. And when we put it into the fund structure, you have 15 to 20 different streams of revenue, all diversified, all flowing up to the fund, and then paying the investors out of that. So that's why I love these things, is they are very low risk, and a lot of them have a lot of repurposability capacity in it, where if you think of a drugstore or a dollar store, they're just boxes. They repurposed for anything. you'll see plasma centers go into them. You'll see Goodwills go into them. You'll see AutoZone go in an old dollar store. You'll see a Sherwin-Williams. Like, you'll see these kind of swap in and out. So that's why I love them. And then in the end, you have a hard asset. So that's why I like it. And then how has it changed since I started? I'd say when I started, interest rates were kind of at a 4 to 4.5, and then they started to dip into the mid 3s, and then since then they've gone up. So with that, cap rates have followed. So I remember my threshold when I first started underwriting deals was a 7 cap was what we needed to hit our return metric to investors. And then as interest rates dropped, we could go a little bit lower to hit the cash flow that we needed. But now we're buying at our weighted average cap rate, and our new fund is at 8.5 cap, and our weighted lease term is 5 years. So cap rates have come up, but obviously because of interest rates. So our cash flow percentages have it's a smaller margin because, you know, we have debt on some of our older deals that are 3.5% debt, and we closed the deal last month that has 6.85% debt. So the margins are a little smaller, but I also think that now is an amazing time to buy because I think, I don't have a crystal ball, but a lot of people would agree with me that interest rates are probably going to come down in the next 12 to 24 months. And with that, cap rates should follow, and we'll have some good assets that are at higher cap rates today, and presumably will be at lower cap rates tomorrow.
Yeah. So, and you said fixed rate debt. What does that look like? How long is it fixed for?
So every loan we get is fixed for the current lease term. So if it's a 4-year lease with Dollar General, they'll put a 4-year note on it. If it's a 7-year lease with O'Reilly Auto Parts, the banks will put 7-year on it. Every bank is different, but I have a line of credit or a guidance line with a bank for $10 million that I can pull from at set terms. And if it fits, if it's an investment grade tenant, fits within a certain box, they'll lend at these. And what I do, and this is where I like, the competitive aspect, is I say, hey, this lender, I go to other lenders and I say, hey, I already have these terms. Can y'all beat this? And I kind of create a competition between lenders to breed us the best terms and get our investors the best returns. So that's fun. And that's just another piece of the puzzle that I can tweak to make the returns higher.
Yeah, that's amazing. And that's a good point. But, being that you have a grade A, tenant in there, that the banks are willing to fix that for the life of that lease, because they understand too. It's like guaranteed money at the end of the day, right?
Yeah, lenders love these deals. It is not hard to find somebody who wants to give you money. They're throwing it at you for this type of stuff.
And you said your average lease term 5 years in the fund, so you're buying these kind of towards the end of their their life cycle, because typically what are you going to see, a 20-year lease or 20-year lease? And is there extensions on that 5 years as well typically, or what's that look like?
Yeah, so there's options built in with rental increases and lease extensions automatic. But yeah, so we're buying anywhere from, I think our shortest term lease was 2 years and our longest term one is 11. So anywhere in there. And so let's just use that 2-year lease term, for example. Like, that property's been there for 40 years, and we like that because the tenant has shown commitment to the location. They've renewed that lease probably 8 times. There's 2 or 3 options, 2 or 3 5-year options on that one. So they've got 15 years left to term. If they want to renew, they can, and we presume they will because they have a low rent per square foot. So that one, actually, we bought it with 2 years, and I went to the tenant and negotiated a 10-year lease extension. So it increased the value. I think we bought it at a 7.5 cap, and now probably got a 5.5 cap, and we made a 60 or 70% return on our equity in that deal in 2 months.
Yeah.
So it's like, that's through relationships that I've created over years of doing this, is calling up the tenant and saying, hey, low rent per square foot, been there for 40 years, let's kick this out for 10 years, and you guys get to keep your rate the same for the next 10 years, and we can go to a bank and refinance at a higher valuation.
Yeah. Wow. Amazing. When you were saying the cap rates, I'm thinking, usually if this is at the front end of the lease, the cap rates are going to be a lot lower. But since you're buying it towards the later stages of the lease, that's how you're able to get those better cap rates. And then what kind of due diligence are you doing prior to purchasing to try to get an idea? Are they going to stay, or could they potentially go, that kind of thing?
Yeah, I mean, one thing we like to do is see how long they've been there. If they've renewed their lease, a lot of times it's typically a good indication. If there's no competition in the town, that's a good indication. We like to buy in some smaller towns. Some of the towns we own in have 2 or 3 thousand people, but if you're the only dollar store
Sure.
within 5 miles, like it's great. We look at the Placer AI reports to see what the foot traffic is, where it stacks in comparison to um, other locations. We look at the CoStar reports, kind of. But a lot of it is just, see what their rent per square foot is, what's the replacement cost. If this tenant does leave, what can we do? We manage 60 of these properties now, and we've had 3 or 4 of the tenants not renew their lease, and all of them have been repurposed to new tenants. So buy a good piece of real estate, and somebody will want to occupy it.
Yeah, typically these types of properties are in good locations. I mean, the prime locations, well access locations, right? I mean, those types of tenants don't want to be behind other retail or in a weird part of town or something like that, right?
Yeah, they do a good job. They have good real estate teams, and there are locations that do go dark and don't renew. But that's where you have good relationships with other tenants, and hopefully they can step in and do it.
Yeah. Now, and how would you normally, in the few times that you've had that scenario, are you guys paying for development costs? Or are they paying for development costs? What does that look like?
So the tenant pays for it, and all of them. We just negotiate a new lease with them and say, hey, our old rent with tenant A was $100,000 a year, and your new tenant, and depending on who the tenant is, they could pay more, 120K a year, or they could pay less, 80K a year. But with a new longer term, the valuation would probably still be higher. Than it's not just about rent; it's about credit, tenant, like their credit rating, and the length of the lease, the location, interest rates, etc. So cap rates. So, but yeah, so we love these. We love the funds. There's a lot of publicly traded REITs or just private REITs too that buy these same assets. They're our competitor. Well, we're their competitors. They're a lot bigger than us. That feed the hope and goal is to wrap and roll all these up and sell them at equity multiple to these bigger private equity groups.
Well, you led perfectly into my next question, which was going to be what kind of metrics, or what kind of makeup of the portfolio do you need to have in order to make sure it's attractive for that roll up and exit to a PE firm at the end of the day?
Yeah, I think like the biggest thing is just being big enough to catch their attention. Nobody, no PE group or REIT wants to buy a $10 million portfolio. I think you got to be at least north of 50 million, and maybe even north of 50 million to really get their attention. So growing a portfolio and making it look as pretty as possible and doing basically all the legwork and the hard work for them is where your value is going to come in. And that's what we're trying to create, is value for these private equity groups, and saying, hey, when we bought this fund or when we bought all these properties, the weighted average lease term may have been 5 years today, but if I can do a good job of negotiating the leases, and maybe our weighted average lease term in a year or two is 8 or 9 years, and cap rates have compressed, that's where our exit is going to be for our investors. Is, hey, we can create this, put together a good portfolio for some group who wants to buy it, and that's the real exit strategy. And our goal and hope is to be a cash flowing investment for investors, because a lot of these investors in our funds were in single family properties, and they own their own stuff, and they got those monthly checks, but we wanted to make sure that we stuck that monthly check, we stuck to that process instead of doing quarterly or annually. So we do monthly distributions, and then really the big pop will come on the exit, and our expectation is that we'll at least double investors' money in 5 years from their initial investment.
Okay, and I was going to ask you kind of that general overview, but let's get to that in a second. Absolute triple nets, or do you do any maintenance at all, or what's that look like?
No, we do both. We do triple net and double net. Every tenant's different. So
all single tenant, or do you do any with multiple tenants, or?
All single tenant. I'm not opposed to doing multiple tenant, maybe like a 2 tenant, like a Starbucks and Verizon or something, or a dollar store. But your question before
on the triple net. So you don't, it doesn't have to be absolute, you will fix certain things and, maybe parking lot or landscaping or HVAC or something like that.
Yeah, so I'd say probably 50 to 60% of our assets are double net. I mean, we are responsible for roof and structure, and we have capital set aside for reserves, working capital, and then we have the team in place to project manage any repairs. So if there's a roof leak, Family Dollar calls us and says, "Hey, we have a roof leak on the northeast corner of the building. Can you send somebody out to do it?" We'll bid it out, get a few contractors out there to tell us their prices, and we'll go with one and go on our way.
Gotcha. So you're managing these internally then?
Yeah.
Okay.
Yeah.
Gotcha. And you said you'll buy anywhere, or do you have certain markets that you look for, or?
Yeah, I mean, that's something that goes into the acquisition criteria is like, we don't want to be super close to the ocean because of hurricanes. We don't be, in high snow areas where we have a roof. Like, we won't be in North Dakota or Minnesota because just the wear and tear that snow puts on roofs is tough.
Yeah.
So we look in specific areas, but we're typically in the Sun Belt, Texas, the Carolinas. We're in Florida, on the Gulf side. So yeah, I mean, we like landlord friendly states. It's not super important to be a landlord friendly state in this triple net stuff, but for multifamily, it's more important. But tax free income states like Texas, Tennessee, Florida are ones that we like. So again, really, we keep the end goal in mind. What do these REITs like to buy? What do these private equity groups, where do they want to be? So we say, hey, let's be where they want to be, and let's buy where their portfolios are heavily weighted.
Yeah. How do you do that kind of work? Have you had conversations with those REITs or PE firms that are interested, or just how do you make sure you're sticking to that criteria?
Yeah, I mean, so there's a lot of publicly traded companies, like Realty Income Corp is one, ticker O, and then NetStreet is one, ticker NTST. They buy these exact same properties, and all of their information is public. You can look at all the properties they own. But we've worked with investment banks who have either taken, the investment bank we worked with took NetStreet public. So they know them really well. They're actually based out of Dallas too, NetStreet. So I've met with the president of that company, and he knows kind of who I am and what my end goal is. But when you're somebody like as big as they are, you got a ton of people throwing properties and funds at you, and most of those people are selling because they have to, not because they want to. So we've looked to package together our current 50, and they're like, hey, like, we'll probably buy it at a discount because there's so many people right now in today's market where they put 5-year debt on it back in 2020, let's say, and it's about to mature at today, and they'll have to rebalance at a higher interest rate. So there's people like that whose backs are against the wall, and there's people like us who are cash flowing great funds, and we don't have to sell. So I think there might be a balance and a good, perfect time to sell in the next 12 to 24 to 36 months. Really, I don't know. But yeah, we just work with investment banks to connect us.
Mm-hmm. Yeah. So, okay, so let's get back to the return. We were talking about that a little bit. So just give me, what are your funds, 506B or C?
Accredited investors only.
Okay. And can you speak to kind of give us a general overview of cash flow numbers versus IRR, through a sale, and then speak a little bit too about the depreciation aspect and that kind of thing, especially because of these being double net and that kind of thing.
Yeah. So we're aiming for a 20% annual return, and that's going to come through kind of 3 different streams. First one's going to be cash flow. That's current cash flow. Let's just say rent comes in for $10,000 a month for a property, mortgage is $4,000, and then $6,000 gets distributed to investors. It's 80-20 split, 80% to investors, 20% to my company. So that's 6.5% to 7% current cash flow, diverse split over 12 months. So let's just call it 7%. We're building up equity in all these assets through paying down the principal. So that's another, we have 25-year AM, no notes on all of them. So that's another 7% or so. And then appreciation. We think that these assets that we're buying today are going to appreciate because of cap rate compression. And that can be anywhere, depending on the market. It can be 1% annually to 10% if you're in the right market. So just kind of average that at 5 or 6%. And that's kind of where you get the 20%. And then from a depreciation standpoint, we do cost segregation studies on every asset. And last year's depreciation to investors was 30% of their initial investment. So this year we think will probably be around the same, around there. Yeah. And that'll come on a K1 to investors and use that to offset the income from this fund, or if you have other passive real estate income. I'm not a CPA, so make sure you talk to your CPA about that. And yeah.
What type of investors do you normally work with? I would think this is, perfect for somebody that's looking to maybe replace their existing income, or just give me a little bit of a profile of the average investor you normally work with.
Yeah, so all of our investors, I guess I'll start with why they like our funds, and I think it's I'm hoping I'm painting the picture right, but they want cash flow. They want cash flow from day one. I think that's what everybody wants, and they also want the opportunity for a big exit, because a lot of these multifamily people, gurus, whatever you want to call them, are having these multifamily offerings where you see zero cash flow, and then you might see a big pop at the exit. So mine has the cash flow in addition to the exit pop. So investors, that's what they're looking for. Our investors most of them are executives at companies, W-2 engineers or CEOs of companies. We have a lot of professional athletes. Like I said, I played pro hockey, so we've got some NFL guys, some NHL guys, friends and family. I mean, we have people who own like food businesses. I'm trying to think like just kind of cool ones, but really anybody who's looking to get in the real estate game wants to be diversified and wants to have cash flow. Because again, like a lot of people I feel like have been burned, especially over the past 24 months, on a lot of value add developments or multifamily deals. And this is the opposite of a lot of variables. The only variable that we have in these triple net deals is what we pay for it and what our debt is. That's not the only variable, but that's the biggest one.
Sure.
So we know what we're buying, and really just an investor that we like to work with is somebody who wants cash flow and appreciates and understands why diversification is important, and understands what we're doing and why we're doing it.
Yeah. And you were saying, how long of a hold should they typically expect? About 5 years, or?
Yeah, it'll be about 5 years. We started this fund about a year ago. So we're about a year into that, and we'll probably close the fund in the next 6 months, and make that fund as pretty as possible, and then wrap it up. I mean, we honestly could sell it at any point between now and 5 years.
That was going to be my next question, was does it need to get to a certain size in order? But it sounds like there's different private equity REITs that'll buy at different stages, right?
Yeah, there's a ton of variables.
Probably just going to get the best pricing the larger it is, right?
100%. Yeah.
Okay.
And there's really no time constraint on me. Like 5 years is just a number that investors like to hear. If we can sell this thing in a year and a half from now and make a double investors' money, I'm going to do it. Like I'm going to do it as fast as I can, because that's better for their IRR and just it makes me look better. So I'm trying to exit as fast as I can for as big of a return to investors as I can, because we're going to just take that money and go do it again.
Yeah. Yeah, I was going to say, well, like, would you ever look at this from a long-term approach? Because like I was saying, the guy that I apprenticeship with, like these were long-term holds. I mean, he was holding in trust for his kids, and it was like, yeah, and that's what they didn't want to manage tenants and toilets and things like that. He didn't want to hand that off to his kids and all. I mean, so would you ever think of a long-term approach, and what would that look like?
I think maybe if I was older and I didn't have the vibrance that I have, I think I have vibrance. I think I have a little bit of youth on my side to put in the hard work and do the legwork. And I think that's why a lot of older investors trust me, and they trust me and they expect me to do what's best for them. And if what's best for them is to flip these, I don't want to say flip, but to, create something that has more value than what we're buying, that's good. But also I think there's more value in a pool of these assets, as opposed to maybe if I did have tens of millions of dollars, maybe I would buy a few of these for my family and just put them in there as a bond, just to have a hard asset, do some depreciation and do that. But, long-term hold, maybe. I'm more interested in long-term hold from multifamily standpoint. I'd like to have 5,000 to 10,000 A-class multifamily units and have these triple net stuff be in addition to that. Both of them are very good assets, very good cash flowing assets. People are always going to need a place to live, but
Yeah.
you're also going to need groceries in small towns. So, um,
Yeah, no, that's a really good point. And I think like to that point too, like the properties that he was holding for the family, they were like Wawa, Chick-fil-A's. I mean, stores that they've never closed. I mean, has Chick-fil-A ever closed the store? You know, it's just like, they're like Wawa's around here, especially with gas stations and all. Like they've literally like it was such a huge deal. They closed some stores in Philadelphia. Yeah, it was like unheard of. Like things were that bad from a crime perspective and that kind of thing. But so talk to me a little bit about the multifamily side of the business as well. And are you guys the operators? Are you, you doing the property management for that as well? And that's I'm interested in that side as well. I'm sure the audience is too.
yeah. So, I mean, like I said, we wanted cash flow, and I didn't want to be a one-stop shop of triple net and commercial kind of assets. So, and I know multifamily really well. I did all the underwritings, like I said. So, wanted to buy something that was already stabilized, didn't have a ton of variables in it, and was highly occupied and a new build. So this deal that we currently have under contract is in the growth path of Lubbock, Texas, and it's 204 townhomes. It's surrounded by single family homes in the $500K to $2 million range, and we're buying this at $140K a door, built in 2022 and stabilized. I bet you could barely build it for that, probably.
Yeah.
Probably build it for maybe 130. So we're getting it at a really good deal, and it's stabilized. So we'll buy that and hold it, and this one we'll put some agency debt on it, and it'll cash flow, like I said, from day one. And we'll operate it from an asset management standpoint, but we have a very good Rockstar Group property management company that has 5,000+ units across Texas. They're going to run it, and they don't take anybody as a new client, and they've wanted to work with me for a while, and I've wanted to work with them. So we're finally going to connect on this one, and yeah, I mean
That's an individual deal, or is that in a fund as well? Or
so this will be a separate offering in addition to the Freedom CRE fund is the name of the fund that we have of the triple net stuff, and this will be a separate multifamily offering individual. So investors will come into this, and it'll be the same strategy of, hey, what can we do to increase the value of this, increase rents, get some other streams of revenue, and refine expenses. This one's currently occupied by the owner. It's owner managed. So there's going to be some efficiencies by dropping in, like I said, that all-star property manager, and look to exit in 3 to 5 years again and still money. Yeah. So, this one's a great asset. We're super excited about it. I think the basis we're getting in it is incredible, especially in the surrounding market. It's surrounded by all super nice homes, and it's in the best school district in Lubbock, and just a great location.
that's amazing. Now, do you guys have an acquisitions team, or you work with brokers, do a little bit of everything, or?
Yeah, so I'm the acquisitions team. You're looking at it. But yeah, I work with brokers at the old private equity group I worked at. Like, I did all the acquisitions there for the triple net stuff and the existing multifamily. So that's just me calling a bunch of brokers, being on all their email lists, following up with them every few weeks. Hey, what do you got in the pipeline? What's next? Here's what I'm looking for. They all know and knew that I was looking for an A-class stabilized property in Texas. And I had a lot of things come across my desk, and this one finally hit it, and made a lot of offers, and here we finally are. But yeah, I'm the acquisitions team, and at some point as we grow and scale, we might need to add somebody. But I had at the old company, I kind of had some acquisitions help, and I just think the experience may not have been there on specific people. So, but yeah, I mean, it's hard to find good people. But yeah, so I'm the acquisitions team.
That's awesome. Now, and you certainly sound like you have the experience to do it. And, I think you said like the follow-up thing, that's the biggest thing with brokers, right? It's just following up and then just showing that you can execute, right? At the end of the day, I feel like is super important, but they're the ones that are making the calls and have the relationships and things like that. So you tap that network, you can't beat that. So you mentioned something, there was two kind of names for two meetings behind Freedom, and one was everything we've been talking about with cash flow, real estate, and then you mentioned your relationship with Christ. Obviously, that's an important thing to me. If you can see the crucifix behind me there, so is that something? Did you grow up that way? Did you come across that? If you don't mind me asking, I'm assuming if you name the company after it, you don't mind having the conversation, right?
I love talking about this, and I love that I can do it on any. That's what I love, that I can do it on any platform. So I grew up in a Christian household, and like I said, I played hockey my whole life, and um, hockey was always my idol. And then I had some injuries lead me to I went to Liberty University, and that's a pretty big Christian Bible teaching school in Virginia. And before Liberty, I always say, you're raised being kind of told what to learn, and like it's kind of just your upbringing and your environment, and kind of like I had a relationship with the Lord, but a lot of it was just kind of what I was put into. So I always say I was a hockey player that just happened to be a Christian. And then at Liberty, the Lord just really worked on my heart, and I did a lot of research into, okay, why do I believe this? Like, this is what I believe, and this is what I've been told to believe, but like, why do I believe this? Am I right? Like, every religion in the world thinks they're right. So I started doing research into just Christianity and other religions, and saying, hey, why is this one right? And Christianity just made a lot of sense to me because it's the only religion that it's not works based. It's not about what we can do, but what Jesus did for us. Every other religion is us working our way up the mountain to paradise, heaven, God. And Christianity is where God came down to us and died for us. So there's the gospel. Jesus saved my life and changed my life at Liberty. And after Liberty, I would say that I was a Christian that just happened to play hockey. And now I'm a Christian who just happens to do real estate. So, my identity shifted from, world, a person that just happened to be a Christian, to now I'm a Christian that just happens to do whatever. So God really changed my life. And really my long-term vision is to create a nonprofit organization that funds Christian missionaries around the world. And I want to be the part of the team for missionaries to fund them, to send them all over the world and tell people about the truth that changed my life. And I want to focus on some specific countries, and Japan is a country that I think the Lord's placed on my heart to focus on and tell people about Jesus there.
Wow. That's amazing. I love it. I love it so much because I as somebody who it's as important to me as it is to you, it's having those conversations in business, and balancing business with your faith and that kind of thing. And it's always been something I've had a love-hate relationship with over the years. And I mean, do I like when people talk about it and that kind of thing? But when it's as authentic as that, you know what I mean? It's just there's something to be said for that. And I think it's great when you can do business with other people that feel the same way, right? You know what I mean? So how would you say it's affected the way you do business and just the way you show up in the world? You know, I mean, that kind of thing.
Yeah, I mean, I'd say I'm a very bold, like I'm very bold in my faith. I think that this life is very short, very temporary, and I think if you don't know Jesus as your Lord and Savior, that the Bible is pretty clear on what that means. I would say I am not somebody to force it down people's throat and say, this is what you have to believe, this is what you should believe. I say, this is what I believe, and this is why I believe it. And if you would like to talk more about it, I would love to sit down and talk to you as long as you want. But I think what comes out of me following Jesus and, giving my life to the Lord, is the byproduct of that is integrity and just being kind and hopefully being different, being a light in a dark world. And that can be in my responses, my reactions, the way that I conduct my business when nobody's looking, the way that I treat investors' money when nobody's looking. I have access to millions of dollars, and there comes a lot of responsibility with that. And there's a lot of people who don't have the same, for lack of better terms, moral compass that Christianity teaches. And that moral compass, I hope, brings people a sense of peace, even if they're not a Christian, because I have a higher power that I answer to. I will one day stand in front of the creator of the universe and be judged for my actions from what the world has seen and what the world hasn't seen. and that's I hope brings some peace to investors with somebody who's handling your money.
Yeah, no, that's amazing. I completely agree with you. I mean, I don't think you could have said it any better, and it's very inspiring, and anytime I see somebody like yourself who is bold in it, I hope it inspires others and inspires me. So that's amazing. A lot of power to you for doing that.
Thanks, appreciate it.
So Zane, how can people find out more about yourself and your offerings and working with you?
Yeah, I'd say the best way to do that is just to email me, and it's just zane@freedomcre.net. So we can probably put that in some notes or whatever, about zane@freedomcre.net, and then our website is freedomcre.net. But yeah, I mean, I'm very relational driven, and like I don't know how many people are going to hear this and how many people will reach out to me, if it's 100, 500, 10, like whatever. Like I'm very like, hey, let's hop on a call. If you're going to trust me with your money that you've worked hard for, the money that you're saving up for your kids' college, the money that you're planning to have as your retirement fund, like we should at least hop on a call. Or
Yeah.
if you want to meet in person, like I'm very open for that too. But yeah, that's the best way to get a hold of me. Just email me directly and say, this is where, yeah.
Yeah, I'm the same way. I think with the internet now and like crowdfunding sites and things like that, you always have that percentage of people that just kind of want to do everything, over email. And like I'm the same way. It's like just pick up a phone and you want to have a conversation, especially for a long-term relationship, and just so there's no surprises and everybody's on the same page. I always think it's just so much easier, and you can get into things on a lot deeper level through a phone conversation than you can through email and pitch decks and presentations and things like that, right?
Yeah. I mean, of course, I want to get you my pitch deck and you can review it, but let's hop on a call after you check it out and discuss what you like about it and what you don't like about it, and we can go from there.
Awesome. Well, Zane, thank you so much for joining us today. I really enjoyed the conversation, and look forward to continuing a relationship with you, and hopefully the audience will as well. And we'll drop your info in the show notes and things like that. But I really appreciate you being here. Thank you so much.
Thank you.